In this week's review of Nelson Nash's Becoming Your Own Banker book, we are reviewing the shortest section of the book, which also is going to be the most controversial and sometimes the most confusing.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And today we're reviewing Nelson Nash's Becoming Your Own Banker. And we're in the section where he's talking about expanding your banking system to accommodate all income. As I said in the hook, shortest section of the book, but also the most controversial.
Cameron, before we dive into it, you mind if I say something?
I guess.
I know you love it when I go off script and you're probably assuming that I'm going to give you a dig, but no, this isn't about you, nor is this about me. This is about people who want to learn about infinite banking. I'm going to give a little pay attention to is that we will be launching an online community. And we are starting with kind of a soft launch. We're going to go with our current clients. And then we're going to open this up to other people who want to learn about infinite banking. So be on the lookout for that. However, in the meantime, if you have questions about infinite banking, want to see if this is for you, hop on a discovery call. Love to chat with you, see what your goals are, and see if we are a good fit.
Nice. Good plug.
Okay.
Well done. Well done. Absolutely. Now let's dive in.
Yeah.
This section of the book. It's great. It's short, 2 pages. Even Anthony can get through it. Anthony, let's tee this thing up, man. Is there a takeaway that you had in this section?
Well, you mentioned at the beginning, one of the things Nelson talks about here is your premiums should equal your income.
Yeah.
And what he's talking about is when you get that dollar, when you get that income, you got to put it somewhere. Would you rather put it in somebody else's bank or put it in your own banking system? Now, that's kind of a loaded question when you phrase it like that. But, one thing I would say, if you're new to infinite banking and you're like, wait a minute, I'm not even sure of having a small premium, and you're saying that we should have our premiums should equal income, you know what? Do not worry about it. We tell people to go slow at your own pace. This is an advanced strategy, and to be honest, that very few people really get to. So if you're not there, don't worry about it. But hopefully we can talk it through of some pros and cons.
That sounds like very sound advice. Well,
thank you.
Yeah.
Thank you.
So what's the controversial part?
Well, for one, that's a big you put every dollar you make, you put into a premium. Like, it sounds great.
What's the downside?
But, you do need some money for, your monthly expenses.
Yeah.
Right.
Yeah.
And thus you put that dollar in to pay for your monthly expenses. You're taking it from the policy.
Yeah.
So how do you, if all your income is in there, how do you live? And then if you take the money out, how do you pay it back?
Yeah.
If that's all your income.
Mm-hmm. Great point. I too had that as really my first kind of point in this book, in this section. We're on page 48, right at the top. The first sentence, he says, it always sounds a bit strange to people when I say premiums and income should match. I agree 100%. Sounds very strange. And in fact, to kind of reinforce what you said is that I know very few people that are on that level, right? And very few people, in my opinion, should even be close to it.
Mm-hmm.
When somebody's first getting introduced to infinite banking, there should be a process, a slow process of education and kind of ramping this thing up. Trying to get all your money into a policy, I think, is probably one of the single worst pieces of advice that I've seen out there on the internet. And I think, if I'm being honest, I think a lot of advisors and agents out there use this page to influence someone new to infinite banking to go too quick and to go too fast. I've looked at this a million different ways, and what happens most of the time is that somebody gets into this, they start putting large premiums in there, they're taking loans on a monthly basis or sooner. And all you're doing is you're creating a huge loan balance on that policy. And if you're doing that year after year and it's an ever increasing loan balance, you're not you're not accomplishing much, right? And it's actually detrimental to kind of the performance of this thing. And so the only way that I kind of see this idea working again is from Nelson's point of view, what I would say is long term. And what I mean by that is several episodes back, as we interviewed David Stearns, Nelson Nash's son-in-law, and one of the things that he talked about was when Nelson got in advanced age, he came to him and said, "Hey, tell me about your loan portfolio. Right? Do you have loans on your policies?" And he said he's a little embarrassed and cut off guard. And he's like, "Yeah." And Nelson's response was good, because what he was framing to David was, "Hey, when I pass, there's going to be a huge windfall for you, and you're going to need a place to put it." And so that is kind of that second generation. There's going to be a windfall. And so I do see this being a fit if we've got a well established generational plan in place where we do have places to put that windfall. But for most people just getting started, I would say that this is often confusing and pretty much detrimental to kind of their implementation of infinite banking.
Yeah, I would agree. This is an advanced strategy, but also one of probably the biggest obstacles in infinite banking is that slow start, right? That early loss of liquidity. You put in $1, you don't have access to that whole dollar. However, each year the policy gets more and more efficient, and eventually you can get to a position where you put in $1 and it's grown by 5.
Yeah.
Right now, so to get to this number, you typically may need to have a multitude of policies, but you need to get to that point where you put in $1 and it's growing by much more. And again, this is advanced strategy. So I'm going to kind of share what my plan is with my policies. Doesn't mean that you need to do it, but I'm just going to share the point of view, because a lot of times when we're looking at our policy, particular premiums, the biggest obstacle people have is they think of their premium as a payment, right? A payment is money going to somebody else, right? But what we should really look at, this is a deposit, because that the money's going from one account you own and control to another account you own and control. So oftentimes, so if we start thinking about our premiums as deposits, when do we want to stop receiving deposits? Right? If the answer truly is never, then one thing I tell you what my plan is, and I know when we do talk to people about and show them an illustration, because we do force people to go through our educational process, and part of that is they see an illustration before they even start underwriting, because we want to go through that loss of liquidity and any questions. And typically what we'll do, and I would tell you what I do, Cam, is our show premiums turning off at some point, and then instead of putting money in the policy, that they're taking it out through a combination of loans and withdrawals. I would that's not what I'm planning to that's not what I'm planning to do. The reason why I show people that is because at that early stages, they're not ready for some more complex ideas. And most people might not even get to those more complex. So we want to start them on something more of a simple plan and encourage them to know you can pay premiums for as long as you want. If you want to pay them to 60, 70, 80, that choice is going to be up to you. We want to keep those opportunities open. So what my plan will be is that I'm going to continue to make premiums. And the reason being, and I was, you put a good point, Cameron, of one option is you have that legacy planning, so this would be ideal if your parents were doing infinite banking, right? And you have that windfall coming in. A lot of our clients, they're the patriarch. They're the ones starting infinite banking for their family. So I'm not going to have a large death benefit from my parents, but what I'm going to do, I want to make sure my kids are not able to say the same thing. So I'm going to be continuing paying premiums because I want my death benefit to be large. And so when I put in $1, particularly at 10, it might be growing by 7 or 10. So I will be intentionally having loans, but my death benefit will pay off those loans upon my passing. But because I continue to pay premiums, my death benefits continuing to rise, which will leave more money to my kids and charities.
Great point. Anthony, what anything else that you want to add to that? Or I've got another section I was going to highlight here.
Nope, go for it.
And reading page 48, that statement is the first one that jumps out at you, right? Like we said, hey, this thing's pretty controversial. Sometimes it can be confusing. The other statement, I read it through a couple of times before I started kind of preparing for this. The other one that really jumped out at me was in the second paragraph on page 48. One of the things he's talking about is the all-American guy putting his money in deposit on a bank. And he says, why does he behave this way? And he follows it up and he says, because no one's ever explained him a better way of doing things. And it says, once a pattern of life is learned in a culture, it is nigh unto impossible to change. His paradigm is fixed, set in concrete. This is the sentence that jumped out at me. The peer pressure and conventional wisdom is overwhelming. For whatever reason, right, that jumped out at me and I started to think about it. And what I did is I actually went out and I looked up some of the experiments that have been done on like peer pressure and conformity. And one of the ones that I found was probably the most popular psychology tests or experiments that have ever been done. It's called the Ash line experiment. And I want to share this with you guys because there's a lesson here at the end. Is that this was done back in the 1950s, but what a gentleman did, his name was Solomon Ash. He got 123 male college students together and he gave them a vision test. And what he did, it was a line. He gave them a line of a certain length, and then he had them choose, or had the ability to choose, three options. One line was longer, one line was the exact same height, and then the other one was shorter. And what he did is he had them choose which one matched up to it. In the control group, they answered privately which one matched up to it. And in that group, they were correct 99% of the time. In the conformity group, what he did is he actually had 18 students in one group. And what he did is he told the first 17 to give the wrong answer. And the last guy, they were testing the response of the last person. And so there this person was, visually can tell that, hey, this is very apparent that these two are equal. But you've got 17 people giving the wrong answer. And so every time somebody gives the answer, right, you can just imagine the peer pressure and the anxiety of what answer to give is rising. But what he did is he actually found out that 75% of people went along with the wrong answer in that group.
75%.
75% went along with the wrong answer, knowing, well, in fact, what the right answer was. Visually, you could see it. I thought that was amazing, just at the level of people that are willing to go along with something just because everybody else is doing it. Absolutely worth going up and looking up that experiment. There's some other details that are fascinating, but I also looked up some of the factors that influence how and when people conform. And to go along with that is there's 5 things that I took away. The first one was conformity tends to increase when more people are present. So he did the same test, but he did it with maybe one person that would give the wrong answer. And there was almost no impact on someone giving the right answer. But the magic number was 5. So when you get to 5 people that give a wrong answer, the likelihood of somebody conforming jumps dramatically. The second takeaway was conformity also increases when the task becomes more difficult. So if somebody's unfamiliar with the outcome, they'll defer much quicker to somebody else. And the parallels that I found just as far as traditional planning is that's their message, right? They're out there saying, hey, this is too difficult for you to do. Nobody else is doing it. So people go, oh, you're right. Nobody else is doing it. So either should I. The third piece was conformity increases when other members are considered to be of a higher social class. Remember those guys we make fun of all the time that go to networking events and are always the best dressed, right? That's why they do it, right? Is because, right, they're trying to come off like, hey, I know more than you do. I'm better suited, right? So that's my own personal takeaway on that one. But the last two were actually ways that conformity decreases. Conformity decreases when people are able to respond privately. So you don't have that social pressure of everybody telling you, hey, this is wrong, this is wrong, this is wrong the whole time. I thought that was very interesting. And the other one was conformity decreases when at least one other person gives the correct answer prior. So go back and read this test, and he had 17 consecutive people give the wrong answer. The results shot up through the roof. Up to 75% of people would then conform. If you have just one person ahead of you that gives the correct answer, the conformity drops drastically. Again, right? One of our messages is always get in community, right? And so that I see reinforcing that idea is you got to get in community with other people that maybe don't question everything, but maybe this idea of conforming, right, is you take a second guess and you try to think stuff through logically. And again, I think that goes around with one of our other messages that we're always talking about is if you focus on facts versus opinions, you're going to be much better off in life.
Cameron, a couple of comments on that. First, Nelson does say nigh in there. Yeah, I mean, like, just you didn't think Cameron's misspeaking, because I would have jumped on it much earlier if it was. Also, well done. That is some good information. I'm still digesting that impact of that peer pressure and really who you hang out with. And, you know, and I'm glad this is the first time we dropped about this online community.
Yeah.
It's making me more passionate to be able to get that so people can feel so that they can learn the truth.
Yeah.
Right.
I'll share another one with you. Just briefly was the Milgram experiment. This was another social experiment that was done back in the 50s. And right, we're just kind of coming out of World War II. And so these scientists are trying to figure out how, this whole persecution kind of happened. And so that's why all these experiments came out at the time. But the Milgram experiment one was, I think most people probably heard this in psych class during college, is that they had one individual that was given instruction on how or when to shock someone and the level in which they would take those shocks up at certain decibels. And so, or voltage meters or whatever it was. But the Milgram experiment, guys, go look that up. That is another fascinating experiment in conformity or just peer pressure. And people were voluntarily cranking up and electrocuting someone because they were told to. And again, that one is scary. The experiment, the person wasn't actually getting
okay, good. I was wondering if they were actors. Or,
it was acting, but man, go look into that one. I'll send a link to that one. But just those two experiments again, I think play a big role in the way that we make decisions. Those are two isolated incidences, and you think about the pressure that you have in life from friends and from family. And man, I think sometimes you got to kind of take a step back or at least stop and just be aware of that peer pressure that's happening.
Well done, Cam.
Yeah, thanks, man. Awesome. What else you got here, Anthony? Page 48. What else jumps out at you?
He talks about a couple things. One was that income. And so I will say, before we get in a little deeper, Nelson Nash was a big mentor in many ways in our life. And we're IBC practitioners, and we follow. I'm not gonna say 100%. I mean, there's some things that we don't, maybe not, some things that we don't agree with in this book, and I think this page highlights a couple of them. And because he talks about two other concepts, and one is once you establish you have some seasoned policies and you have some cash value, he's looking at other ways to expand your banking system. And one way he talks about is kind of self-insuring part of your auto insurance, particularly collision, which means if it's your fault, you will be on the hook to pay for any damage as opposed to the insurance company. And when so we've often talked, we've been doing infinite banking for 15 years.
15 years in a day.
Or 2 days, whatever. But I would tell you, when I first read this, again, particularly early on, I was looking ways to expand my banking system and get additional policies. So I started looking at this. And then I tell you, at that point, my oldest son, had turned 16. And I won't go into too much detail, but there's been a couple cars that were totaled that were our fault. So I was very thankful that I had that collision, because I didn't want to take on that risk. Because if we really look at what insurance is, it's really like we are pooling our risk. For example, let's say you live in a cul-de-sac, and say the odds are that maybe somebody's house may get burned down. And so instead of you having to take on all that risk, maybe you get with a group of people and say, hey, let's just kind of chip in and we're kind of share the risk. Because odds are not all of our houses will burn down, but if one will, we kind of all chip in to really absorb that risk. And then you start to expand that. You need somebody to handle that process, which is where insurance companies would come through. So really what we're doing is, do we want to take that risk, or do we want to share that with others? And I would say at that early age, 15 years ago, I did not want to share that risk. But then as we were preparing for this, I'm like, well, okay, you know what? My kids they have their own auto insurance policies. It's just me and my wife. And I will say that if running over curbs was a sport, like, my wife could be, competing for the national championship. Right. But, so I actually looked at my policy to see, what am I paying for my collision? Like, I got enough cash value, and I'm wondering if I could absorb that risk. And I'm like, well, how much am I paying for that risk? And I was surprised how little it was.
How much was it?
It was a little over, like, between $200 and $300 a year.
Oh yeah.
But then, you know what? I would tell you, I don't think I shared this on the podcast. Hopefully I didn't tell you, but about a year or two ago, I was backing out of a parking lot, and this was kind of during the lockdown where I was at the vet. So they had, like, they put up these tents to protect, so you could stay in your car and they'd come out to you. And then when I was backing out, I'm holding my little pug. That's a whole nother story. But I back up and my side view mirror hits the pole. And then it's too late. So I just backed up, and it kind of just made it worse, and to be honest, I probably could have went in there and said, hey, blamed it on them, that they should have more space. But the bottom line, that was my fault. Damage was about $3,000, and my deductible was $1,000. So really, the insurance company, absorbed $2,000 of the risk. But when I look at it, if I were to save, $200 or say $300, that'd take me a long time to really absorb that money back.
Yeah. And
I even looked at it with at $300. I mean, my car right now, because I'm about to sell it, is worth $17,000. So it would take me 56 years if I were to total my car. Take me 56 years of saving that collision to really be ahead. So on this piece here, I don't concur about self-insuring. Maybe your situation's different, but for me, I'll pay over my $300 to Geico.
56 years is a long time.
Yeah.
It's also a long time before I'll get this vision out of my brain of you backing up, ripping off the mirror. And then if you were to walk in there, I can only imagine you getting out of your car, holding
my pug,
with you and the pug walking in. You guys are probably wearing matching sweaters. going
Were you
there,
there?
going there and yelling at them about a pole ripping off your beer. So that'll be a long time before I get that vision.
And then when I got home, I blamed my wife.
Of course.
Anyways,
Yeah.
but
we digress.
You're welcome.
Let's keep moving on. I agree with you on that part of it. I won't belabor it anyway. What Nelson kind of adds on to kind of that, he makes a great comparison. Page 48, second paragraph on the right hand side of the page. And one of the comparisons that he's making is really he's asking or highlighting what's the difference between a bank and an insurance company, whether it's life insurance or comp and collision. And so really that's my question for you guys. What's the difference between a bank, an insurance company, and I'll even throw in a mutual fund in there? My answer would be nothing, just the sign on the door, right? The sign on the door is what's different. They're all just depositories for a place to store your money. I think it's a great takeaway that all these businesses are relatively similar. So he outlines that in that section. The other one that I thought that was worth noting is up in the top right on page 49. But what he talks about is he says, of course, you can speed up the ability by adding new life insurance on someone. It doesn't matter who the insured is. All you want to do is own the policy that you can, so you can control the cash values. Anthony, I know you got some policies. Any idea of how many you own on other people other than yourself? Just rough numbers.
Probably now my kids have their own, so probably 3 or 4.
Okay. I think that's a great example. And oftentimes we'll have this conversation around insurable interest. That's what he's saying is that, hey, you don't have to buy a policy on yourself, but you can get a policy on someone else. When insurable interest comes up with clients is typically when somebody is either older or not in the greatest of health. And so we'll go through this idea of, hey, maybe buy a policy on someone else. And so what you're looking at is you buying a policy on either a family member or a business partner or something like that, where they're the insured, but you're the payer and owner of the policy. And so I thought that was worth highlighting as well. We do get some questions around that.
Well said, Cameron.
Yeah. What else you got?
One thing he also talks about is taking over your mortgages and that interest that you are paying to the bank, you can pay that in your policy. Now, again, I think that sounds reasonable.
Yeah.
Right. However, typically we're not a big fan of paying off the mortgage. And really, it depends on the client and what your goals are. If your dream is that, to own that house free and clear, then that's something that we can use the policy to do. Or I would say if you hate banks, and I don't blame you, because if we're paying interest to the bank, we're going to pay bank or interest to the insurance company.
Mm-hmm.
I mean, so that interest is going somewhere. And one thing I want to be clear is just taking a loan and paying back interest is not going to increase your policy. Loan repayments just fill it back up. The only way to expand your banking system is to pay additional premiums. But I know there's many clients that don't like banks, right? They don't like the structure or telling, the service that they get or what they're doing with the money. And so what I'm saying is I think paying off your mortgage using infinite banking is great, not on a spreadsheet, but it's kind of more of something if that's what you are more of a personal belief or something that is important to you. And if it is, then you should do it and we can help you do that. But one thing I would encourage if you were to do that or when, that we would get a first lien HELOC or home equity line on that policy. And the reason, even if you hate banks, I'd still recommend you do that, because if you have that paid off, you can't tap into that equity without getting permission from a bank. And as everyone knows, banks only want to loan you money when you don't need it. So when you do need it, you may not be able to get access to it from that equity. And we did a podcast on this earlier where you can have a first lien HELOC. There will be expenses to set it up. But if you don't draw on it, it doesn't cost you anything. And again, I think that ability to have access to that liquidity would have a lot of advantages.
Well said. Well said. Last piece I'd add is just the second part of that same paragraph, the sentiment that he was making is make sure that you pay the policies whatever you would have had to pay a mortgage company to amortize such indebtedness. That's the idea of being an honest banker, right? If you're going to do this, making sure that you repay those loans, again, is one of the single greatest fundamental ways that you can ruin this whole thing, right? So if you take a loan against a policy, we've got to make sure that we're setting up some sort of loan or amortization schedule back to the policy.
This is the shortest section. And I'm like, dude, we're going to have a 15-minute, 20-minute podcast. But, hopefully we did provide some value, and we want to discuss these concepts. And, I think the main point is you need to come up with your own decisions, right? And your own beliefs. These is what Nelson says. And we agree with probably 99% of what he says, but we encourage you to learn about, just like you said before, don't follow people's opinions, create your own facts.
Well said. Hope you guys enjoyed this episode.
Make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.